All right, Walter Wofford back. Another video. Today we're talking about seller financing. I've done this many times in front of a crowd of investors. Might have 100 people, real estate investors in the room, and I ask the question, who has ever negotiated a seller finance purchase when you're buying a house? And about 5 to 10% of the hands go up. And I ask the same question, who's done the same thing when selling a house, negotiated with a homeowner, let's say, for financing a house to them? The same 5 to 10% hold their hand. So apparently there's a gap in what investors learn about finance. And I've been told this many times, that real estate is not about tenants and toilets. It's about finance. And so today we're going to talk a little bit about techniques that we use here in Jackson for both buying and selling with seller financing. And we'll end it up with a talk about wraparound financing that I know you'll find interesting. All right, Walter Wofford, thank you.
In today's real estate market, you could be a buyer, right? And you're looking at these interest rates just soaring.
Yeah, they really jumped.
From maybe 3% just, a year or so ago, up to nearly 7% now. It makes that dream home suddenly feel, pretty much out of reach.
It really does. Or maybe you're on the other side, you're a seller.
Right.
You've got this great low-interest loan locked in from years back, but the buyer's coming through. They just can't qualify for new loans at these current high rates.
So your place just sits there.
Exactly. It's a huge shift, isn't it?
It absolutely is. I mean, that kind of rate jump.
It translates into hundreds, sometimes thousands more per month for a buyer's payment.
Wow.
It's effectively kicked, nearly half of potential buyers out of the market, buyers who could have easily gotten a loan just a few months back.
So it's not just a challenge, it's like a complete roadblock for a lot of people.
A total roadblock.
And that roadblock, that friction we're seeing everywhere in the market, that's exactly what we want to dig into today.
Okay.
Our mission here is to unpack this really powerful strategy, one that often gets overlooked: seller financing.
Right, seller financing.
We've been looking at insights from Walter Wofford. He's a real estate veteran, 42 years in the business.
It's a long time.
And get this, he actually bought his first house using seller financing way back in 1981.
Wow, so this isn't some brand new idea.
Not at all. His experience just shows how relevant it still is, maybe even more relevant now.
Yeah, and what's really interesting, pulling from Walter's insights, is that seller financing isn't some tiny niche thing. Historically, it's accounted for something like 20% of all real estate deals nationally.
20%? That's significant.
It is. And our goal today is really to show you why it's seeing this big comeback, especially when those traditional bank loans are just harder and harder to get.
So prepare for maybe some surprising facts here. We're going to try and cut through the noise.
Okay.
Show you how this approach gives you a real edge, whether you're buying or selling. It could really reshape how you think about these deals.
Let's do it. Turn these challenges into an advantage.
Exactly. So Walter explains it like this, right? We've got this perfect storm, inflation driving up costs.
Which then leads the Fed to raise interest rates to try and slow that inflation down.
Right. So picture that seller again, the one with the nice 3% loan on their house.
Okay.
If a buyer today needs a bank loan, they're looking at, say, 7%. That payment difference is huge.
Right.
It makes it incredibly hard for that seller to move the property unless they're willing to basically, pay money out of their own pocket just to make the sale happen.
And that difficulty, that seller may be having to write a check just to sell, that's where seller financing steps in.
That's exactly it. It becomes more than just an alternative. It's like a key tool, an arrow in your quiver, as you said.
It completely changes how you think about adding value in the deal. Absolutely.
Yeah.
You're not relying on some third-party bank anymore. You and the seller are creating the financial agreement directly.
Okay, so that brings up a big question then.
Yeah.
What kind of terms can you actually write for yourself with seller financing that a bank would just never offer?
That's the core of it. And Walter mentioned something that sounds almost too good to be true for buyers.
Yeah.
Unlimited money.
Unlimited money. Okay, how does that work? That sounds a bit wild.
Well, it's not about having, an infinite bank account.
Right, okay.
It's about the flexibility. With a traditional bank, they look at your overall credit, how many loans you already have. Maybe they cut you off after 10 properties, right?
Lending limits?
Exactly. With seller financing, you're negotiating directly with the seller on their property. The deal is tied to that specific house, not your entire financial history.
Ah, okay.
So for investors who want to buy multiple properties, maybe they're already capped out with banks, this just opens up a whole different path.
That's a really powerful difference. The focus shifts away from digging into every little detail of your personal finances.
Yeah, and that leads to another huge plus he talks about.
Which is?
You often don't need those exhaustive personal financial statements. You know, the profit and loss, the balance sheets.
Ones that take hours to fill out.
And potentially expose all your private financial details.
Yeah.
Walter Wofford actually says he's never given a seller his credit report for any of his seller finance deals.
Never. That adds a big layer of privacy.
For sure. And then there's the interest rate itself.
Right. The big sticking point right now.
Exactly. Today's market might be around 7% from a bank, give or take. But with seller financing, you negotiate it.
You mean you could get lower?
You could. Walter talks about getting and even giving 0% interest loans sometimes.
0%. How?
Especially for shorter-term deals. He often says interest can be a figment of your imagination. It depends on what you negotiate.
So you can sort of play with the price versus the rate.
Precisely. Maybe you agree to a slightly higher purchase price, but get that 0% interest for a year or two.
Or maybe a lower price, but you accept a bit more interest.
Exactly. You design a win-win that fits the situation, something a traditional bank just isn't set up to do.
Okay, that makes sense. And for people borrowing a lot, this next point seems huge. Non-recourse with no personal liability. What does that mean exactly?
It means if the deal goes bad, maybe you can't make the payments anymore. The seller's remedy is to take back the property through foreclosure. But crucially, they cannot come after your other personal assets, your savings, your car, your other properties.
Wow. So the risk is contained just to that one property.
Yes. Walter says 100% of his seller finance deals have been non-recourse. Even, he says, his own personal home.
That's incredible. Compare that to a bank loan where you often personally guarantee it.
Right. If the bank forecloses and sells the house for less than you owe, they can come after you for the difference. It's a massive difference in risk.
And this also ties into how you actually hold the property, right? Like the entity you use.
Yeah, Walter prefers using trusts. He jokes, it's hard to arrest a trust.
Huh. Okay.
It just provides more privacy and protection compared to owning it in your personal name or even an LLC, which are usually easy to look up in public records.
So more privacy, less personal risk.
Yeah.
And you also get incredible control over the actual payments, right? The terms.
Absolutely. Say you're buying a rental property and you figure the rent income will be around $700 a month after expenses. You can structure your payment to the seller to be maybe $350 a month.
Yeah.
That gives you breathing room for vacancies, repairs, whatever.
You set the payment amount that works for the deal, not what a bank's formula dictates.
And the duration, too. Banks have fixed amortization schedules, 15 years, 30 years. Here, you negotiate it. Could be 5 years, 10 years, interest only for a period.
You could even negotiate a delay in starting payments.
Yes. A moratorium. Maybe you agree payments don't start for, say, 3 or 6 months after closing.
That gives you time to fix the place up or find a tenant before the payments even kick in.
Exactly. Crucial cash flow management.
Okay, one more clever trick Walter mentions. Potentially buying your own note back.
Yeah, this is neat. You can put a clause in the contract, a right of first refusal. Meaning if the seller ever decides they want to sell the mortgage note that you owe them, maybe they need cash, they have to offer it to you first.
At what price?
At whatever price a legitimate third-party buyer is offering them. So if someone offers to buy that note from the seller at a discount, say 70 cents on the dollar.
The seller has to offer it to me at 70 cents on the dollar first.
Exactly. You get to essentially buy your own debt back at a discount, and you let someone else do the negotiating for you.
That's another layer of strategic control. Very smart.
It really is.
Okay, so we've heard all these amazing benefits for the buyer. Unlimited money, flexibility, privacy, non-recourse. Which naturally leads to the question, why on earth would a seller agree to all this? Why not just hold out for cash?
Well, remember that opening scenario. The seller who's stuck.
Right, the one whose buyers can't get loans.
Seller financing directly solves that problem for them. It creates a buyer where one might not otherwise exist. But there's another huge, often costly reason sellers are open to this.
Okay.
Avoiding vacant property insurance denials.
Tell me more about that. That sounds specific.
It's a painful lesson many people learn the hard way. Even Walter, with his 42 years of experience, said he lost $25,000 last year because of this.
$25,000? How?
If a property sits vacant for too long, usually around 60 days, and then something happens, a fire, vandalism, a burst pipe.
Yeah.
The insurance company might just deny the claim entirely, citing the vacancy clause in the policy.
Ouch. So the seller is left holding the bag for the full repair cost.
Or the total loss. By offering seller financing, you give that seller a compelling reason to accept your offer quickly. They avoid the ongoing costs, taxes, utilities, maintenance, and more importantly, they avoid that massive risk of an uninsured loss on a vacant house.
That makes a lot of sense. It's not just about price, it's about risk mitigation for the seller.
Exactly. And there are tax advantages for sellers too.
Okay, like what?
Well, if it's an investment property they've owned for over a year, selling with financing allows them to potentially use an installment sale for tax purposes.
Installment sale, meaning?
Meaning they don't pay capital gains tax on the entire profit in the year they sell. Instead, they pay the tax proportionally as they receive the principal payments over the life of the loan.
So it spreads out their tax hit, makes it more manageable.
Much more manageable. It smooths out their income and tax burden over potentially many years.
And what about if it's their personal home they're selling?
There's Section 121 of the tax code. Generally, if you've lived in the house as your primary residence for 2 out of the last 5 years, a large portion, sometimes all, of the capital gain from the sale is completely non-taxable. Up to $250,000 for a single person, $500,000 for a married couple.
So if they sell their home using seller financing,
The interest they receive each year is taxable income, sure, but that big chunk of profit from the sale itself, often tax-free.
so it becomes a nice, steady, mostly tax-advantaged income stream for them, potentially much better than just sticking a lump sum of cash in a low-interest savings account.
Exactly. It can be very attractive, especially for retirees, for instance.
Okay, this is painting a picture of real estate investing as, well, Walter Wofford sees it as a kind of progression, right? Like steps on a ladder.
Yeah, he lays it out quite clearly. Most people start at the bottom rung, maybe as landlords,
Just owning rental property.
which he calls the lowest rung, maybe the simplest entry point. Then maybe they move up to buying and selling or wholesaling.
Flipping contracts, basically.
Right. And that can be a good business, make decent money.
But
But it often comes with a really high tax bill. That income is usually treated as ordinary income, subject to self-employment taxes too. Walter jokes, if you get good at wholesaling, you'll be good at paying taxes.
because you'd be paying a lot of them.
Precisely. He mentions knowing an investor who owed $90,000 in taxes from wholesaling one year
Oof.
and was projected to owe $270,000 the next year.
Wow.
That kind of experience often leads to what he calls the wake-up call,
The wake-up call being,
learning about retirement account investing, using self-directed IRAs or 401k to invest in real estate.
to make the gains potentially tax-free or tax-deferred.
Exactly. It can completely change your net profit by eliminating or deferring that huge tax chunk. That's a big step up the ladder.
Okay, so landlord, then wholesaler facing high taxes, then discovering retirement accounts. What's the top rung, according to Walter?
The ultimate model, the fifth position he describes, is doing it all without needing banks.
Using seller financing on both sides.
Yes. You negotiate to buy a house using seller financing, ideally using your tax-advantaged retirement account entity.
Okay, so buying tax-free with flexible terms.
Then you turn around and sell that same house, maybe to a homeowner or another investor, also using seller financing.
But presumably at different terms.
Yes. At a higher interest rate, maybe a longer term, maybe a higher price.
So you're creating a spread.
Exactly. This is the wraparound mortgage strategy he champions. You might buy low, say, 0% to 3% interest from the original seller, and then sell high, maybe 8% to 10% interest to your end buyer. You're essentially creating your own private bank.
And because it's happening inside your retirement account.
That income stream, that difference between the payment you make and the payment you receive, can be completely tax-free and last for years, even potentially beyond your lifetime, depending on the structure.
That sounds incredibly powerful. It shifts the focus from just finding cheap properties to creating value through financing structure.
Completely. It allows you to compete based on the benefits you offer, the flexible terms, the easier qualification, not just haggling over the lowest price.
And you're saying most investors aren't even aware of this.
Walter reckons it's a tiny percentage, maybe less than 1%, who are really leveraging seller financing strategically like this. Most are still stuck in the traditional models.
Wow. Okay, so just to recap then, we've really explored how seller financing isn't just some, backup plan.
Not at all.
It's a strategic powerhouse, really. It offers this incredible flexibility and control, especially when the market gets tight like it is now.
From getting access to deals, even if banks turn you down, that unlimited funding idea, bypassing credit checks.
Right, the privacy aspect, plus the non-recourse protection for buyers.
And those significant tax advantages we talked about for both buyers using retirement accounts and sellers using installment sales or their Section 121 exemption.
It really lets you kind of write your own rules for the deal.
It empowers you to do that, yes.
And this deep dive really highlighted that progression in real estate investing.
Moving beyond just being a landlord collecting rent or being a wholesaler paying tons in taxes.
Towards these more sophisticated strategies, using retirement accounts and then ultimately creating your own sort of non-taxable long-term income.
Like with that wraparound mortgage strategy, buying low, selling high, using financing as the tool, creating your own bank, essentially.
And hopefully you listening now have a much clearer picture of why sellers are often quite open to these kinds of offers.
Yeah, it's not just desperation. There are solid reasons.
Like avoiding that vacant property insurance nightmare, that $25,000 lesson. Even a veteran like Walter learned.
A very costly lesson. Seller financing avoids that risk for them.
So this knowledge, understanding seller financing, it really gives you another arrow in your quiver, right?
Yeah.
It lets you compete on benefits, on the structure of the deal, not just on having the absolute lowest cash price, especially when most other investors might not even know this is an option.
Right. So what does this all really mean for you, the listener?
Yeah.
Well, Walter Wofford has that great quote. If you think education is expensive, try ignorance.
That hits home.
And this isn't about being smarter than anyone else necessarily. It's simply about being informed.
Right. So maybe consider, what opportunities might you be missing? What deals might be passing you by just because maybe you haven't explored this flexible approach yet?
Yeah. What's the next thing you'll choose to learn to unlock more potential in this market that's always changing?
A provocative thought to end on. Definitely something to think about.